Welcome back to another weekly episode. So, before we move forward, keep your notifications on because, as such, the system will never recommend my videos. So, this video is about the turnaround that is happening in the banking and financial sector. When I write BFSI, this includes banking, finance, housing finance, insurance, capital markets, IPO market, nearly everything that is covered in this space. So, you have to understand. I'll just read out a couple of things that are important when it comes to understanding what is happening. So, India's financial services sector stands at an unprecedented inflection point in 2025. Why precisely 2025? I'll explain that to you. With the macro fundamentals, asset quality matrix, and growth trajectories creating an environment that strongly favors banking, finance, insurance, capital markets, and asset management stocks. So, this was an update that I'd put out on my Insta profile, and I'll just explain in detail why I think over the next few years, banking and financial space is going to grow leaps and bounds, irrespective of what happens globally. So, the transformation from crisis ridden sector of the early 2010s, which is the period mainly between 2015 and 2018, to today's robust ecosystem represents one of the most dramatic turnarounds in global finance. So, now let's come to the financial sector performance in 2025 for the time being. This is the sister stock concept of Jesse Livermore, where we see how many stocks within a sector move up. This particular sister stock chart sees how many industries within the sector are moving up simultaneously. So, this is the entire BFSI space: banks, insurance, capital market, asset management, and finance in general. Finance includes housing finance, auto finance, everything. So, you can see there is a sister stock movement that has begun post February 2025 in this particular space, and nearly every stock or every industry in this particular sector is moving up simultaneously. I'll put up some charts also. So the first is about the banking space. So within the banks, you've seen NPA cleanup happening, better capitalization, and credit revival. Indian banks are cleaner, stronger, and ready to expand profitably, a massive contrast to the stress laden environment of the early 2010 2017 period. And I forgot one point, which is about the regulation of RBI. Again, the banks are being regulated in a way which is laying the foundation of double digit growth in the next 10 odd years. The first is NPA. Gross NPAs have dropped to about 3.2%. This is the lowest that we have seen over a decade. 10 years ago, India was reeling from a major bad loan crisis. NPAs peaked at 11.2%. Of course, the majority of the brunt was in the public sector bank space. The IBC, which is the Insolvency and Bankruptcy Code. Again, this reform has strengthened the recovery and the discipline process that is in the banking system today, which was missing 10 years back. Provisional coverage ratios have improved. Banks now have robust buffers. Strong regulation by RBI has also strengthened the entire BFSI space. I'm just giving you a backdrop in terms of quantitative analysis. I'll take you through some charts also. And the last point is the growth. Credit growth is running at 14 to 16% year on year. And this is largely being driven by MSMEs and corporate capex also. The private sector capex has still not picked up a great deal, but that gives you an opportunity. It gives you an opportunity because if the capex has to pick up now, that would further add to the growth of the banking sector. When I pull out a simple ratio chart of Nifty Bank against something like Nifty 500, that is the broader market index, here I'm comparing against Nifty because against Nifty 500, it is even better. It's even better because the broader markets still are not doing that well as opposed to large caps, which is Nifty 50 and Nifty 100. Look at the relative strength. While the fall happened, RS was trying to move up, and now it is a firm trend in play. You're seeing nothing but a consolidation here. We might test out 50 DMA, who knows? But eventually, Nifty Bank, Finance, all of these pockets are going to head higher. It is represented by this strong trending relative strength, which tells you that a lot of accumulation is actually happening in this sector. The next pocket is about private bank. Now, private banks, if you look at the RS here, and the next chart is public sector bank, look at the RS here, it clearly tells you that in this cycle, private sector banks are performing much better when you compare it with public sector banks. So this particular relative strength that you see in the banking sector, it is largely driven by private sector banks. And this is where your focus has to be. There will still be a couple of public sector banks that will do well, mainly the major public sector banks, but the cycle belongs to the private sector banking space. And this is something you should not ignore because allocations depend on how strong relative strength is in terms of trend. The next pocket is NBFC's capital market. Now, the shift brings sticky annuity like income for AMCs, wealth managers, brokerages, and fintech platforms. So what this means is that there is a shift happening in our economy, because of which the income for AMCs, wealth managers, brokerage stocks, and fintech platforms are going to go up. I've divided it into four main points. One is capital market. Today, India has over 15 crore demat account. Earlier, we didn't even have 2 or 3 crore account in the previous decade. That is between 2010 and 2017-18. SIP is now in tune of 20,000 crore a month. Again, this was 10 years back at 1800 to 2200 crore. Digital infra. This is something that is changing a lot of things for the entire BFSI space. The digital infra that we have today, this was virtually non-existent 10 years back. And this digitization that is going on is largely going to benefit NBFCs. There is one important point I also want to add, that is the benefit of artificial intelligence for the entire BFSI industry. Whether it is assessing customers, whether it is segregating customers into various categories, that is the high profit customers as opposed to customers on which you have to spend, that is the companies have to spend. All this analysis now will be done by AI, that is in real time. So any customer or any corporate house that is a customer of the BFSI space, the margins on those customers are going to go up even more because of the data analytics that is going to come into this space. Artificial intelligence, I don't know about any other sector because that is not my forte, but artificial intelligence in BFSI space is going to be a game changer in terms of margins. Whatever margins you are seeing today in this industry, those margins will be rewritten in terms of expectation. That is why this is something I've reiterated many times about the banking space, that in the next 10 years, bank nifty or financial industry is going to go to levels that the most optimist analyst will also not be able to anticipate today. And so you have to understand that the BFSI theme is not a 6 month kind of a theme. It is a theme that is going to last for at least a decade. When it comes to cycles, there are primarily two kind of cycles that play out in the sector. The first is a cyclical kind of a cycle. Cyclical kind of cycle depends upon economy, XYZ things, and it generally does not last for multiple decades. The another kind of cycle is a secular cycle. A secular cycle starts and lasts for over a decade because it is largely driven by change in demographic profile, that is customers. In our case, it is also due to progression that has happened with artificial intelligence, and the most important point, it is because of technology related changes. That is what a secular cycle is in the market. Like you take the example of SIP. Now, due to digitization, it has been relatively easy for us to go from 2000 crore a month to 20,000 crore a month in 10 years. Now, whenever the cycle starts to mature, the growth is exponential. That is why the growth in the BFSI space is going to be much sooner than people are anticipating. And that is why I feel the analyst estimates for this particular sector are going to go wrong in terms of being conservative. Let me now quickly open up the chart of Nifty Capital Market Index. Again, the RS bottomed out in March 2025. The trend was confirmed in the mid of April 2025. And now the trend is in motion. You have to focus on these pockets when you see bouts of volatility in the market. And volatility will be there. It's like breathing in and breathing out. Currently, the market is heading higher. It will pull back. Whenever pullback happens, then look into these spaces, especially if you believe that this space is going to do well over a period of time. The next pocket that will also perform well is the insurance sector, which has moved technically from a push to pull kind of a sector. The insurance penetration in India was barely 2.7% in 2005. Even as of 2015, life insurance remained a product that was sold, not bought. This is an important statement. It's an important statement because relationship managers across banks or other entities used to push this product to customers. But now this product is no longer a product that is sold, that is pushed out. This is a product now that people are buying, mainly due to awareness. Especially post COVID, if you see, there has been a lot of awareness of people with respect to protecting the future of their families. It is a major driver when it comes to people taking insurance. There's a lot of schemes also by the government due to which insurance companies benefit a lot. Then comes the penetration. The penetration today stands at 4.2%, and by 2030 it's going to be 6%, which is still so low given the kind of demographic advantage we have and the kind of growth that will happen by 2035, 2040. So the penetration is something that the market share of these insurance companies will keep going up. And if you see, there are a handful of insurance companies, I think 4 5 major private companies, and then the government companies also. So there is a lot of scope. And of course, the digitization. There are a lot of companies now that give you comparison of insurance schemes. You get the insurance copy issued in a matter of minutes. So this is what is also enabling this particular sector. If you look at the relative strength chart of the insurance sector, again, look at the relative strength. This is beautiful outperformance, clear trending structure. This is 50 DMA. Price will visit 50 DMA. That is when you have to look at these pockets. The next pocket that is going to benefit is the asset management industry. The mutual fund and portfolio management industry is now a force in Indian financial markets. And again, we are just starting. We are just starting because the per capita income is going to go up. People are going to be less dependent on physical assets, primarily real estate. And India's equity culture is at an inflection point. A lot of digital content is also to be attributed towards the growth that is happening in terms of financial literacy, especially people who make content that is valuable, not the nonsense kind of content that you see on majority of platforms. So even younger generation is now trying to get into the equity market from the long term point of view. I can tell you this because of the queries I receive, of course, in the comment section, and a lot of you contact me personally on Instagram also, just discussing few things. I do get a sense that a lot of younger generation currently is trying to get into equity from investment point of view. So AUM growth, so in 2015 from 10 lakh crore today to 50 lakh plus crore, SIP AUM now contributes over 10 lakh crore. Again, this is massive. This is massive, but given what is coming in terms of demographic advantage, this is still relatively small. That is why asset management industry has a tremendous future. Handful of players are there in this particular industry. Fee and scale. So passive investing is growing rapidly, increasing AMC fee, efficiency, and scale. So if you don't have an asset management company, then the closest way to participate in this industry is to own some really good asset management stocks. Basically, HNIs, family offices turning to alternate investment funds, PMS. This is a huge sector in terms of potential. Still, it is under-owned given what is coming. Valuations today are just about fine. They're not cheap, but corrections will happen. That is why this is a multiple year kind of a theme. I know people don't like to think in terms of decades, but if you recollect last 10 years of your life have just gone like that. The next 10 years will also go, unless and until you plan for something. Time never waits for anyone. That is why year after year, time just flies. 10 years is going to just go past you. You won't even come to know. This is the reason why you have to think in terms of decades. When I made the defense video, it was about the next decade. In between, you're going to get massive opportunities, but you won't be able to capitalize on those opportunities if you don't have your eyes open. Same goes for the BFSI space. If you look at the asset management company in terms of relative strength, still it is not near all-time high. Relative strength is now coming out of a consolidation period. So this sector again has a lot of scope. Below 50 DMA, revisited to 50 DMA and has bounced back. Again, it is going to come back at 50 DMA. This is where you have to look for opportunities. Now, you got to also understand the historical context where we were and where we are going tomorrow. Between 2005 and 15, financials grew. That is, the sector was growing, but it was largely weighed down by NPAs, inefficient PSU dominance. There were relatively less private sector players, especially in the insurance domain, in the asset management domain. Between 2015 and 2020, there was a lot of formalization that happened, mainly due to GST and whatever reforms were coming out. But then we had the NBFC crisis and COVID. Between 2021 and 2025, UPI happened, digital infra push, equity adoption. There was a lot of opportunity here, but there was tight regulation by RBI, and rightly so, especially in the NBFC space, in the banking space. That is why the majority of cleanup has happened. NPS today stand at a decade low. Now 2025 and 35 is the opportunity. This is the seed. The tree has started to grow, but will reach its full potential in the next decade. Higher disposable income, per capita income will rise, more awareness, equity culture, digitization, and in general, economy moving more towards informal to formal. So India is undergoing a once in a century financialization wave, a shift where households, businesses, and even governments are moving away from informal cash based operations towards digitally enabled, credit verified, tax visible, and asset backed system. This is not just a banking story, it's a multi sector revolution impacting capital formation, savings behavior, consumption models, and even job creation. So UPI, Aadhaar, DBT, GST, EFFO, this is the pillar. Impact is 24/7 digital identity, payment later. Sectors that will benefit are fintech, NBFCs, wallet brokers, digital lenders, B2B SaaS banks, insurers, mutual funds. CAPEX, SIP, DMAT penetration, wealth transition, this is a pillar. Impact will be demand for credit, insurance, bonds, retail capital formation, intergenerational asset planning. This is basically, this will be done by family offices. Look at which companies do this. Banks, NBFCs, infra AMCs, brokers, registrar exchanges, wealth managers. So this is basically the capital market side of it. I've just tried to give you a framework. What is the pillar of the financial industry and which sectors in general are going to benefit? Let me come to something very short term in nature. Next week, we have the RBI policy, and I think RBI has a tremendous opportunity here. It is not that nothing can go wrong in our country. In fact, if you look at the GDP data, you look at analysis of GDP data, that is growth numbers, it is clearly visible that economy in general is slowing down. It's happening globally also, but when you compare it with rest of the world, India has much better growth, much lower inflation, balanced fiscal deficit, current account deficit is also totally under control. I think just about 1.1% of GDP. Fiscal deficit, I think the government has proposed about 4.6, 4.7%. It is well within limit. Inflation is within what RBI is willing to accept. This means RBI has a golden opportunity to cut rates by 50 basis points due to a rare confluence of favorable macroeconomic conditions. Inflation has moderated, the fiscal deficit is under control, current account deficit is stable, supported by forex reserves, which are still, I think, in tune of positive $550 billion. So a proactive rate cut would not only boost investment sentiment, but also support growth without risking macro stability. This is extremely important because look at what is happening in the US, what is happening in Europe. Their overall macro fundamentals are just not in place. Plus, there are a couple of other things as well. If you look at the US particularly, government of the US is not in sync with Federal Reserve. Whenever, remember this as a golden point, whenever you see Fed going against what the government is proposing, in general, stock markets will remain volatile. That is why I feel global volatility is not going to go away because US markets are going to remain volatile. Whenever you see government and Reserve Bank of India working together, that is when stock markets and in particular BFSI space does exceedingly well. To get competitive advantage amidst slowing global momentum, RBI will have to kickstart growth in our economy again. And there will be no better opportunity than today. That is next week. If RBI can cut interest rates by 50 basis point, because I think the general consensus is 25 basis point, it is going to be a game changer from the short term point of view also. I don't know what the RBI is going to do. They are obviously much knowledgeable and aware of whatever is happening in the global market cycle. So obviously the decision is up to them. But I personally feel that RBI has an amazing opportunity to kickstart a slowing down economy. Don't forget our population. Don't forget there are a lot of jobs that need to be created. Jobs will only be created if there is liquidity in the system, if ease of doing business again, which government has to work at. Again, banks will have to lend money. There has to be a lot of things that has to fall in place for job creation to happen, and I think that is where India is lagging currently. Yes, we have this amazing statistic that we have become the fourth largest economy in the world. We are going to become the third largest economy. Fantastic, we all have to celebrate that, but we also have to focus towards 3-4 things. One is investment in education, investment in healthcare, job creation opportunity. We have to limit this mindless freebies. This is a serious risk to our economy and in general stability of this country also. So there is a balance that has to be struck, and I hope the government and RBI move in the right direction. RBI takes advantage of the macroeconomic situation that we are there currently, and and cuts interest rates aggressively so that that is eventually passed on to customers, consumers, that is, spending increases, the economy gets a short term fillip. From the budget we got that in terms of more money in the hands of middle class, but now RBI has to do this. I don't think 25 basis points is going to be that great in the short term. It may have some impact in the long term, but let's see. So now let's come to the caveat. There is always a caveat that has to be spoken about, because that is what balanced analysis is all about. I just explained this to you. I'll just read it out to you. In the US, there is a growing disconnect between Federal Reserve government and the judiciary, creating uncertainty in economic policy. While the Fed is focused on containing inflation through tight monetary policy, the government continues with aggressive fiscal spending, widening the deficit and complicating the Fed's inflation fight. Let me ignore the judicial part because it's not that important in the short term. For the RBI, this misalignment is a concern because it adds to global risk premium, triggers capital flow volatility, and can weaken the US dollar stability, impacting emerging markets like India. RBI must therefore balance domestic rate decisions with a close eye on external shocks driven by US policy incoherence. And that is why I feel next week is a golden opportunity. You never know what is going to happen in June. One day President Trump gets up and starts doing something completely erratic. Who knows what is coming? So in this current environment, if RBI can push our economy towards growth a little bit more, I think it's going to serve us good in the short term, medium term, and even in the long term. Ultimately, I don't know what the Reserve Bank of India will do. Last week's all comments were answered, and all of you who had sent me personal queries on Instagram also have answered that. And let me know if you have any queries. I'll definitely answer it over time. Take care, be safe, and have a wonderful weekend ahead.